Okay, we're going to look at now just some demonstration problems. We'll show you transactions that affect revenue, expenses, and withdrawals. So we're going to do our transactions the exact same way we've been doing. Nothing really changes. Just to go a quick review of where our temporary accounts fit in with capital. We have Maxine Andrews Capital is the big owner's equity account. This is the main one. This is the permanent account. Permanent accounts will, between accounting periods, after we close everything out, we'll have a balance going into the new accounting period. The temporary accounts will reset to zero with every accounting period. Okay, so travel expense, ticket sales is revenue, and then we have our withdrawals account. So looking at the big T account, capital, we know increases on the credit side, and we know revenue increases capital. We know it decreases on the debit side, and that's where we have our expense and withdrawals accounts. Those all decrease our capital. So you can see there's the rules for each individual account. We need to make sure we memorize these rules. It will make our transactions a lot easier. So if we look at our first transaction, this is analyzing a revenue transaction on July 25th. Andrews Promoters, which is a business, received $4,500 in revenue from cash ticket sales. When we're reading transactions, anytime we see received money for sales or fees, service fees is a big one we'll see a lot, that's revenue. Automatically let that trigger revenue in your head. So which two accounts are affected? We know we received money. Okay, if we receive money, we know that's cash and bank. And why did we receive money? It's from revenue from our cash ticket sales. So ticket sales is going to be our second account. So what's the classification? Cash and bank, we know for a long time, is an asset. Ticket sales is a revenue account. It's as simple as that. Nothing changes. We're just adding a couple new types of accounts. So after we go from there, which account is each account increased or decreased? Cash and bank, because we're receiving money, is obviously increasing. Our ticket sales have increased. We've sold more tickets. We've made more money from selling tickets, so that too is increasing. So which account is debited? We debit cash and bank for $4,500. We know with every transaction has to have a debit and a credit. So ticket sales then is credited for $4,500. We'll see how this works. Cash and bank is an asset, so it increases with the debit. Ticket sales is opposite, so it works out, and everything is still balanced. So that's how we'll do revenue. 9 times out of 10, when you have a revenue, it's going to be cash and bank. If you receive the money now, if they're going to pay later for ticket sales, say somebody bought tickets for $4,500 and they're going to pay for it later, they bought it on account, then it would be accounts receivable increasing by $4,500 and revenue increasing. Let's take a look at another one. Now we're going to do an expense account or an expense transaction. Andrews Promoters issued a check for $300 to Ace Airways for travel expenses. Okay, so which accounts are affected? Obviously, anytime, and you're almost always going to see the word expenses. When you see that, automatically look for that account. And then because we issued a check, most times when you're paying an expense, you obviously have to pay for it with cash or write a check, so cash and bank will be affected regularly. Classification for travel expense is an expense account. Cash and bank, again, just like last time, is an asset. So increase or decreased. This is where it can kind of get a little tricky because you're paying something with an expense, okay? But remember, they have the same rules. So travel expenses, the amount that we've paid towards travel, the amount that we've paid towards this expense is actually increasing. However, because we had to write a check to pay for it, cash and bank is decreasing. So what's our debit? We know travel expenses has the same rules as assets. They increase with the debit. So we know travel expenses are debit for the amount of the check. Cash and bank is decreasing because money's coming out of the bank. So that's our credit for $300. When we look at our complete entry, travel expenses and cash and bank, there's the rules. You can see they have the same rules. Okay? So one's got to go up, one's got to go down. Travel expenses is increased by $300. Cash and bank is decreased. We have our debit and credit, and we're all balanced. So we look at our last one. This is for an owner's withdrawal transaction. Anytime you see the owner's name withdrew cash from the business for personal use, whether they wrote themselves a check, took cash out, whatever, we know that it's going to be withdrawals, and we know that it's going to be cash and bank. Now, classification, again, withdrawals is a withdrawals account, owner's equity. Cash and bank is, again, an asset. So, increased or decreased? Again, this is just like expenses. The amount that the owner has withdrawn has increased. Maxine Andrews has now made $500 more worth of withdrawals, so withdrawals is increasing. However, the cash is coming from cash and bank, so cash and bank is decreasing. So which account is debited and for what amount? Withdrawals increases with the debit, so we know that's our debit for $500. We know cash and bank is credited because there's money coming out. So one more time, let's look at it with the T accounts. Same rules, so it's got to be one increase, one decrease, because we have to have a debit and a credit. So withdrawals is our debit, and cash and bank is our credit.